Good morning again, and welcome to Real Estate Economics weekly webinar series for San Diego County. This is part 2 of 5, so if you would like to view all 5 parts of today's series, please make note which parts you're on. If you recall, you can start and stop these at your convenience and skip or listen again to any sections that interest you. This particular piece today is the 5-year price and volume trends section, and we'll also be addressing income and employment factors. This graph shows 5 years of price and value ratio history for both attached and detached products, covering April, only April for the period 2006, April 2007, 2008, 2009, and the most current data that we're presenting today, April 2010. If you can see the price history on the far left side of the graph, as of April 2006, we were roughly at a market peak during the course of this time period. Prices and value ratios were both at close to peak levels for this particular cycle. A couple other months were equally high, but this generally represented a high water mark in this area as of April 2006. As you can see, coming forward 1 year, April 2007, the value ratio has degraded a little bit, as has the overall price point at 444,205. And what's happening in this time frame from 06 to 07, and more noticeably to 08, is we're getting a shift out of as high of percentage of attached sales as we were previously. Detached sales are much more prevalent in April 2008, taking about 2/3 of the total market share versus just about 60% in the previous year, and that's enough to keep the average base price from declining, but value ratios are clearly off significantly. As we come forward to 2010, we move more into detached products as the detached homes become much more affordable compared to years past, and a lot of the demand migrates out of the higher density condo programs and into detached homes, which have become much more affordable. Now you'll see in this particular market area from April 2009 to April 2010, we've had a pretty robust change in prices, with a trough in place, at least on the April data from year to year, moving from $211 to $240 per square foot, and up from $357, almost $358 to $393 over the course of this year. Many of these sales are short sales and traditional resales. We've seen rental investors cull the foreclosed and distressed inventory very carefully, buying the best homes in the best areas, often at huge discounts, but the appeal of these has been so strong that the volume's been good, and at least on the April series we've seen a trough on pricing. We'll have to see how that goes forward. We recognize this is only a month, but on this basis we're showing good price stability on the April series. If we look at the volume, you can see the relative mix over time here. Back in 06, the attached sales had actually come up to this level where they were more than 1/3 of the total sales volume, about and 40% roughly in 2007. Now by 2008, detached sales have sort of reverted to a more historical number of about 2/3 of all the market activity, with the attached being about 1/3. As you can see in 09 and 2010, more demand is flowing to the lower density alternatives, and conventional SFD product is catching the lion's share of the market. A little bit of change in April 2010, where we see a rebound again on the condo side. We'll talk to this a little bit more, but there seems to be quite a bit of activity in high demand locations and high demand markets, people that have been priced out of their favorite areas for 10 or 20 years in many cases, are moving back into some of these areas and buying a home now that the prices have come down quite a bit. This particular series is 3 years, unlike the past, which was 5 years, and you can see the distribution of sales year to year to year by price range. The yellow bar is 2 years ago, 2008. The burgundy, if you will, pinkish maybe, is the 1 year ago data, and the purple is the current data. As the market disruption progressed, you can see quite a bit of volume come out of the higher price ranges in the yellow bars of 2 years ago and migrate down a classification or two into lower price ranges in the pink for 2009. But when we come forward to 2010, you can see increases over 2009 data on the 4 to 500, 500 to 600, 600 to 800, all the way up to the 1 million plus. This is a consistent theme we've been seeing across many coastal markets where people are moving back into high demand areas, buying trophy properties, buying hard to acquire locations now that the prices have come off quite a bit. This is not just unique to San Diego, we might add. We've seen this up and down the California coast and in some high demand settings like Aspen, Colorado, Santa Barbara, California, and similar places. Let's talk to employment real quick. As you can see here, this is the employment history for San Diego going way back to 1990. This market tended to be underappreciated a little bit and didn't have that great a job base until the late 90s. And with that job expansion from the late 90s, this market became tremendously undervalued in terms of home prices. We'll talk to that a little bit later. And in the early 2000s, prices rose quite dramatically here as the housing stock was unable to keep up with the employment base. You can see this market experienced a little bit of a surge that we relate to the housing bubble in 05, 06, 07, when the last peak in terms of job totals took place on the ground. And now we're back to about 1.2 million with a little bit of growth over the forecast period, steady growth accelerating in the back years, so that by 2014 we're just a little bit over 1.3 million, which was about our historic peak of 2007. Here's the year-to-year data. As you can see, this area had fabulous growth in 96, 97, that whole period, with a little bit of a drop-off in the early 2000s. We associate that through most of the western part of the country with the dot-com situation. Then we had good growth leading into about 2006, where we suffered the current recession started to take hold. San Diego's been a market that went in and out of cycles a little bit ahead of the rest of the country, so by 2008 this economy is already losing jobs. Many other markets held off a little bit longer. Conversely, San Diego County tends to come out much earlier, and we can see that in the 5-year forecast, where we pick up quite a bit of steam by 2014. This is median household income. This is a series that tends to grow on a very steady basis. You can see the year-to-year differentials are very small. 1.5 or 2% is a good number here. We're a little concerned about disposable income at this point in time. With higher state and federal taxes, we hope that buyers are taking home enough money to save for a down payment and to put away a few dollars to meet the rising down payments associated with tighter credit. Here's the household income on a yearly basis. You can see in the right-hand column 4% growth in 06 and 07, very robust number, dropping down to 1.4% for 2010. Many markets we see are negative, so this is a very good series as we compare to the other markets regionally. That's part 2 of 2 for our weekly webinar series covering San Diego County. Please make sure you see all 5 if you're interested in viewing the whole series, and we will begin on our end to put together part 3 in just a couple of minutes.